Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Well, James, no surprise yesterday that the RBA left rates on hold, but I was struck by the headline on your piece, which was that the RBA is stuck in a Ray Dalio doom loop.
Well, yes, I've been. Look, I mean, we get obsessed. We get obsessed about where the next move in interest rates is. But to me, I think the bigger story here is just how quickly everything has changed. You know, it's about 3 months since we thought rates were coming down further. Inflation was under control, and now we've whipsawed back to inflation being a huge problem. Rates are going up. I just think we should step back. I mean, this has been an extraordinarily quick easing cycle. Now we might be going into a hiking cycle. Would it really surprise anyone if we were in an easing cycle again by the end of 2026? Wouldn't surprise me based on what we've seen. And I think this just goes to that idea that central banks are stuck in this sort of fog. They're data dependent, which is totally fair enough, but it means they're backwards looking. And you just think of all the data that's hitting them and all the changes in debt markets, in geopolitics and politics. This is where the Ray Dalio sort of theory of the world.
Yeah. So what is Ray Dalio's doom loop? What is it?
well, he says that there's there's five big cycles. Well, one's the debt money cycle, one's domestic politics, one's geopolitics, one's nature, so that could be pandemics or natural disasters, and the other's tech. And they all shape the course of history. His point is that 3 of them are colliding right now. There's too much debt in the world, and debt's at unsustainable levels. But we've got these wealth gaps that have polarized domestic politics, and we've got this geopolitical situation that means that security is being preferenced to economics. You know, it would be much smarter to try and get inflation down by relying on globalization, but everyone wants to be self-sufficient, so we go down an inflationary path. Dalio's point is that these 3 things are colliding, you know, and governments are effectively stuck. They know their debt levels are unsustainable, and they probably need to raise taxes and cut services. But because of the geopolitical situation and domestic polarization, they can't do either of those things.
But why is the Reserve Bank stuck there?
Because central banks are stuck too. All these geopolitical and political decisions mean that central banks are constantly trying to judge where the neutral rate is, and they're whipsawing between inflation and growth. Inflation and growth. Is the economy growing, or are we suddenly back in inflation? And so I think central banks are in the dark. My point is that, you know, just as governments are stuck in that sort of doom loop, central banks will be too. They're not going to be able to confidently say, oh, yep, we're in a period of growth now. Oh, yep, we're in a period of inflation, because so much is changing all the time.
Yeah, so it seems to me that the sudden flip to that rates are going to go up next year is a bit premature, because, I mean, really what's happened is that inflation's gone up from 3.6 to 3.8%. And it is only just above, on the core inflation trimmed mean thing, it's only just above 3%. Now, when interest rates were raised for the first time in May 2022, they just got the March quarter CPI for 2022 a few days before that, and it was 5.1%. I mean, obviously they had to increase rates, but at 3.8% and 3.2, I think it is for trimmed mean. I don't know. I mean, I just think that they're much more likely to just hold where they are. And the idea that, you know, that they've cut too far at 3 rate cuts this year is crazy, I think. I mean, it's got to be. I think it's the shallowest rate cut cycle in history.
Yeah,
you know, the fewest rate cuts ever.
But this is my point, Alan. Like, we're all obsessing about what the next move is. Isn't the bigger story here that, like Michelle Bullock said, she's now in the position of trying to make these fine calibrations to rates, because no one really knows where the neutral rate is. where the economy is neither expanding or contracting. And nobody ever knows where that is. It's always a bit theoretical. But there's so much coming at the RBA now that trying to find that mark is going to be much more difficult. And I think we're going to get these shallow cycles of easing back to hikes. What do we do next? These debates about these calibrations are going to get a lot more difficult. That's my point. I mean, I think you're right. We probably are too premature on the whether we need hikes. Maybe we were a bit too premature with the cuts, but like the RBA's got no idea. None.
No.
The economists have got no idea. We're all just groping around in the dark because these big issues, these big cycles that Ray Dalio's talking about, roll on and sort of steamroll over us. It's always going to be hard to find that balance between growth and inflation. And even then, when we do find it, it's going to be quite fleeting, and none of it goes to fixing the bigger problems that we can all see. So anyway, I'm just trying to step back and look at the bigger picture here.
James, I think the most important thing is that nobody admits that they've got no idea what's going on.
No. Well, and Michelle Bullock was good on this on Tuesday afternoon. She said, we've got to make a forecast. We've got to have a forecast out there. What's the point if we don't? And I think that's right. But it's really difficult for the RBA at the moment, hugely difficult. And, that's why we're seeing these huge, we shouldn't underestimate how big the shift in market positioning around rate hikes has been in 7 weeks. We've seen bond yields move in 7 weeks in just almost unfathomable ways. My point is, I think we can see more of that because, the RBA is backwards looking, data dependent, and it's got this really tough balance between an economy that's lacking productivity growth, and so the speed limit. They're not sure where the speed limit of the economy is. They're not sure where neutral is. I just think to your very point then, Alan, there's so much debate about these narratives. I just think, if you're an investor out there or a homeowner, you shouldn't be trying to figure out where rates are going. It's going to be very difficult.
Yeah, James, did you see the other day KPMG came out with something on how many houses or what proportion of houses in the country that first-home buyers on average earnings can buy? And it's come down from 30 to 12%. So that's unbelievable, really. I mean, only 12%, 1/8 of the houses can be bought by first-home buyers on average wages. And I don't know. They haven't been doing it for very long, so I don't know what it was like 20 years ago, but it was surely more than 12%.
Well, I mean, I watched with interest on Sunday night, I think it was, Alan, your piece on immigration. And, I mean, that goes to it partly, doesn't it? That we still haven't tempered immigration to the housing market in any way, shape or form, have we?
No, that's right. Well, neither political party has an immigration plan, really. I mean, they talk about that we need to have fewer, or coalition does anyway. But really, there's no kind of plan about how they're going to achieve it. And, I mean, the most recent thing that's happened this year is that when the universities went to the government asking for more money, the government said, well, we can't give you any money, but here you can have more foreign students.
Yes.
And so so in September we had a record number of foreign students. I mean, what I had on Sunday night was just a piece about the number of temporary migrants in the country at the moment, which is a record high of 2.9 million. Now, I think about 700,000 of those are tourists and backpackers, but the rest of them are probably joining the queues for rental properties. And that's another 10% of population.
And it's just that sort of pressure that we keep seeing. I mean, you do the same thing, you get the same results, and we all sort of shake our heads. But it's just, I don't know. It's a bit exhausting, isn't it, Alan? You concentrate a lot more on this than me, but
well, it is. It's another doom loop, James.
Sorry, yes.
We've got bristling with doom loops. Christ. Now, James, you had a very interesting piece on copper the other day, just talking about BHP particularly, but just a big picture question, which occurred to me as I read your piece, is the copper the new iron ore for Australia?
It could be. The problem, though, Alan, is we probably don't have enough of the stuff in Australia. So whereas iron ore is all here, that means we get the state royalties and the company profits, tax on company profits. With copper, the biggest and best deposits that our miners are working on is in South America, in Mongolia, in places that aren't Australia. Yes, BHP has a big deposit in and around Olympic Dam, which is
in South Australia.
And very exciting. But yeah.
But are they sure? Have they looked hard enough?
What do you have for more copper?
Yeah.
Oh, look, I mean, people are always looking. There's Rio had an interesting discovery out in Western Australia, but the size of it doesn't seem to have been large enough. So no, I'm not sure it is going to be our new iron ore. I think we're struggling to see what our new iron ore is.
Maybe it's iron ore.
Yeah, it might be. It might be for a while.
So what's happening with BHP? They've missed out on Anglo, right? The Anglo's gone with Teck, something called Teck.
So Wednesday morning our time, Anglo and a Canadian company, Anglo-American and a Canadian company called Teck, agreed to a merger of equals. BHP, of course, famously had two goes at Anglo, one in May last year and then one in November as a sort of final attempt to try and, play spoiler of this big merger. They couldn't pull either off. Well, I guess what's been interesting for me, Alan, is that we get to talk to the miners at least every 6 months when they do their results, and inevitably they're asked about, are they going to do any M&A? And for the best part of a decade, they've told us, no, copper prices, the price of copper assets is just too high. And yet the price of copper just keeps going up, and so does the price of copper assets. So I think they missed a trick back in, 2016 to 2020, and probably even from 2020 to 2023, that they thought at the time these copper assets were too expensive, and arguably they were. But they've only got more expensive. It's like an Australian house in the suburbs. And so now they're all sitting there trying to develop more copper exposure. BHP's got the world's biggest copper reserves, but it's got four big copper growth options around the world, one in Arizona, one in Australia, in South Australia, one in Chile, and one in Argentina. But they're all quite long-dated options, so they're not going to be up and running within the next, say, 5 years. So they're still producing plenty of copper, but in the next 5 years, that production will dip because the grades in their copper mines are going to fall away. Just more waste product needs to be dug through to get to the good stuff. And so, yeah, it's just interesting that the big miners who have all the technology and all the models, maybe they read this one wrong.
We should possibly explain why everyone's interested in copper now. It's because it's the best conductor of electricity apart from silver, and silver's too expensive. So copper it is, and the world's electrifying, so there's going to have to be a lot more copper to carry the electricity.
Yeah. Well, the copper story's been all about the energy transition for the last 10 years, and now it's all about data centers as well, because data centers need lots of copper. So it's got more tailwinds than almost any commodity in the world. That's why everyone wants more of it.
So I had lunch yesterday with a bloke and his wife who are engaged in a startup,
right?
Australian startup called Space Solar Technologies, and he's trying to get a thing up for locating solar power in space. And there's a lot of this going on at the moment. And he's, he talked to me because he's having trouble getting anyone interested in Australia in this idea. So the idea is that you have these massive satellites with solar photovoltaic cells that collect the sunshine, collects electricity, turns the electricity into microwaves, right. And the microwaves get beamed to Earth and turned back into electricity. So you don't need copper all the time, you can actually transmit electricity via microwaves over a long distance, like 9 kilometres in orbit, and you lose a fair bit. But because the sunshine is not being filtered through the atmosphere, and also it's you can collect it 24 hours a day all the time, you get much more of it. So you do lose half of the power, or half of the energy in the transmission. Anyway, so this guy reckons that China is well down the. They're working very hard on this, and he reckons they'll be doing it fairly soon. But the other thing is that the CEO of Google, Sundar Pichai.
Yep, that's it.
He keeps talking about having data centers in space.
Yes, he keeps talking about it every interview.
Every interview he does, he talks about data centers in space. And that's for two reasons. One is that you can collect the sunshine, the electricity from solar power directly, so it's much more efficient, but mainly also because you don't need water to cool them. And because you're in space, it's really cold, so they don't get hot.
Not so easy to knock up a data center in space, I wouldn't have thought. But look, anything's possible, I guess.
Well, I'd say watch this space. Something's going to happen, I guess. Watch this space. Get that.
Very good. Got it. Let's do some questions, Alan.
Okay, before we go to questions, let's have a quick word from our sponsor.
Are you paying too much for your life insurance? Many Australians are, and plenty don't even realise it. InvestSmart can help by giving you quotes from leading insurers so you can compare and spot potential savings. Share a few details and you'll get a range of plans and prices to look over. Why pay more than you need to? Head to investsmart.com.au/life-insurance to get started.
Okay, first question's from Tim. Please explain why the removal of government subsidies for electricity for consumers impacts inflation. Electricity company issues a bill for $200, government pays $75, consumer pays $125. Why is this calculated differently to a bill issued for $200, whereby flatmate A pays $75, flatmate B pays $125? Oh, that's a fair question. It seems nonsensical for a government subsidy to be excluded in an inflation calculation, and when it's removed, inflation spikes.
Well, I don't think it's excluded from the headline calculation, is it, Alan? I'm pretty sure that's right. It is excluded from the trim mean calculation, as is power and food. So I'm not sure it is excluded.
No, it's excluded from the price of electricity, clearly. So it is excluded from the price of electricity. True. The question is whether it's included in the CPI or not. And the trim mean puts it in, and the headline leaves it out. But the way that they've structured the rebates is that it comes off the price.
Yeah,
it isn't the same as flatmate A paying $75 and flatmate B paying $125. It's not that the government's paying part of the bill; they're actually reducing the price, and I think they're doing that deliberately in order to keep a lid on inflation, the official inflation numbers, at the same time as helping with the cost of living.
Well, not anymore because the rebates are ending now. So
they are. That's it.
It's not a problem Tim will need to worry about anymore. And I don't. To be fair to the RBA, they've been looking past this as well. So I don't think it's been a big factor in our interest rate calculations. Archie says, love the podcast. Your discussions about Australia's housing crisis usually focus on supply, immigration, interest rates. But Archie says there's an ultra power positive feedback loop, not a doom loop, a feedback loop. The belief that property is the best investment that is overlooked as the biggest factor. After more than 25 years of rising prices, home owners have repeatedly benefited, and young Australians have grown up seeing property as a guaranteed win. But property values ultimately depend on someone being willing to pay more for something later. If enough buyers start questioning whether they need to own property or refuse to meet ever higher prices, the cycle can shift. But that's the problem, isn't it, Alan? Because of that immigration impulse, that the demand keeps going up, supply is relatively limited, and so it's hard to start questioning whether the cycle can come to an end.
Yeah, it's interesting, isn't it? I mean, I wrote that quarterly essay on housing a couple of years ago now, and I thought at the time, well, everyone says housing's unaffordable. It probably is. Therefore, if something's unaffordable, it can't keep going up in price. And bugger me, it did.
Yeah.
I mean, so, and then, people say, the sensible economists say, well, it can't have been unaffordable because if it goes up in price, it wasn't unaffordable.
Which is a reasonable argument too.
I know. And the thing about the investing in housing is the gearing. That's the point.
Yeah.
The house prices over time have gone up a bit less than the share market. So it's, in terms of it being the best investment or not, it's not the best investment. It's not it hasn't been a bad investment, but it's not as good as the share market. But the reason it's better is because you can borrow 80%. Whereas in the share market, you can only borrow 50% and nobody does that anyway. So really, it's all about borrowing. The whole attraction of housing is the fact that the banks are prepared to lend you 80% of the value. Well, that just makes it fantastic because you put $20 into a $100 house and it goes up by 20%, then you've doubled your money. It's marvellous.
Well, you're not helping Archie's theory that some buyers will start questioning the positive feedback loop. There, you've done your best to build it up.
Well, I certainly think that people will only believe that housing's a bad investment if it is a bad investment for about 10 years.
Yeah,
I mean, nobody will be persuaded otherwise just by people talking about it.
Or we have some sort of shock where we see a sudden rush of properties on the market, but they're very hard to predict, aren't they?
Yeah, it's hard to, as you say, I think that the supply-demand balance is going to remain roughly where it is for a while. I mean, immigration, the population growth is 1.7%. Maybe it'll come down to 1.5%, but it's not going to come down to 1% again, I think.
No.
And they're trying to increase the supply of housing, and maybe they will. But the thing is that even if they kind of put supply and demand in balance, which is kind of what they're trying to do, that's not going to bring prices down.
No.
The only thing that will bring prices down is if there's an oversupply, and a big one.
Yes. That is very hard to. It's hard to, in your mind, work out the circumstances by which
I often think of, in relation to this, when my dog, my Labrador Sam, who's sadly passed away, he was overweight, and we took him to the vet, for something else, and the vet said, "Look, this dog is overweight. You've got to get him down in weight." And I said, "Oh yeah, well, what do we do to achieve that?" And he went to the whiteboard and he drew a big circle and said, "This is what Sam currently eats." And then he put a vertical line through halfway, and he said, and rubbed out half the circle, and said, "This is what Sam needs to eat in future." That is to say, if you want the dog to lose weight, you've got to cut his food intake by half. And I always think about that because you can't actually achieve a loss of weight just by eating a little bit less. And it's the same with housing. You're not going to actually get prices down unless something drastic changes.
Yeah.
You have to, have a big oversupply of housing. You couldn't just do it by a little bit, by increasing the supply of housing a little bit.
Yep. We're stuck in, dare I say, Alan, the doom loop for a long time to come, I think.
Oh, another doom loop. I love it.
Yeah, that one was
James says the Future Fund's been in the press for the wrong reasons. As you would know, the Future Fund is a sovereign wealth fund, although it seems to be earmarked for future unfunded government superannuation liabilities, which it is. There's nothing seeming about it. It's true. That's what it is. Current value $252 billion, mandated to invest for returns at CPI plus 4 to 5%. Since its inception, it's returned an average of 7.8%. Against an average mandated return of 7.8%. So what's his point? Why isn't Australia borrowing more and sticking it in the Future Fund? Because the cost the cost of debt is 4.6% at the moment, and if you borrow at 4.6%, and earn 7.8%, you're making 3.2%. Well, that's true.
And we could pay down the debt, the non-deductible debt, faster.
So the government should just borrow tons of money and hundreds of billions of dollars, and give it to the future fund and say, off you go.
Again, the theory's okay. I'm not sure. The capacity issues might be a problem. How do you? I don't know. Let's say we borrowed another $1 trillion to stick in there. That's what the national debt is. I mean, how do you invest all that? Can you guarantee the returns hold up? Is that does the future fund need a new mandate? Those are all important questions. I mean, I guess the theory's okay.
Yeah, but as soon as you did it, you borrow all this money, you stick it in the future fund, there's a stock market crash.
Yeah.
And you're in the poo.
Yeah. Back in the doom loop, so to speak.
Another doom loop.
Donna and Martin says they're writing on behalf of their teenage children. They're listening social media recommendations to boost their interest in knowledge and investing. Both their parents are listeners and love the podcast. And their teenage kids have small investment portfolios gathered from birthday money, gifts, and even their baby bonus. The eldest, who's 19's now got notional control, but she'd like her parents to keep managing the money. So if we don't have any suggestions for sort of teen kid investment podcasts, is it time for Alan and his grandkids or the sidekicks and their kids to deliver some content to harness early investing? And how's this, Ellen? We love Chris Kohler's work, but even he's too old for the teens. That is you'll have to tell him that. That's quite a blow.
Oh, well, he's 36, so yeah. I mean, yes.
Interesting idea. Maybe you'll have to put that on the Invest Smart whiteboard and think about that one.
Well, speaking of which, I hope the teens are over 16, because if they're under 16, there's no social media anymore.
Yeah, indeed.
They're out.
Can they still get on Apple Podcasts or Spotify or whatever?
Oh, I think so.
I think so. So
yeah.
That's not a bad idea. And particularly because not even if you don't have a portfolio like Donna and Martin's kids, everyone's going to be approaching superannuation. We're all investors in Australia, aren't we? So it's actually maybe not a bad idea. One for us to think about. I don't have any recommendations though. I confess, Donna.
No.
Gap in the market.
David says a black swan event is taken to mean something that nobody thought of or thought possible, and is a term often used to describe unexpected impacts on financial markets. However, we should say that I think it was who invented the word black swan? It was
Taleb.
That's right, Nicholas Taleb.
Nassim Taleb, yep.
And it was about the fact that people arrived in Australia, or Western Australia, I think, and they didn't think the black swan was possible, and there they were. Do you think questions around the White House attacks on the independence of the Federal Reserve are significant enough to cause a dislocation in financial markets in the first few months of 2026? To answer this, then it says we should be listening to a podcast, which, all right, we'll take you up on that. But so I don't think that the White House attacks on the independence of the Federal Reserve are enough. But if they do actually remove or damage the independence of the Federal Reserve, then that might be a big deal. So the question is, who do they appoint as the replacement for Jerome Powell, the chairman of the Federal Reserve, and will that person then do everything Donald Trump says? Because Donald Trump came out recently and said he thinks interest rates, the cash rate in the US should be 1%.
Yeah. And he said overnight in an interview that he expects that his Fed appointee will lower interest rates very quickly. But there's a few things that need to go through. Like, that the Trump's appointee looks like being Kevin Hassett. But unless there's some blowing up of the way the Fed operates now, which I guess is possible, but it's not what we're being told is going to happen. The Fed will still be a committee with several voters who make a decision, and it's a democratic institution in a way that the majority wins. So one person isn't going to be able to take control of the Fed. That's one point. The other point is, I think this wouldn't be a black swan because we all know it's a problem. We're all hyper-focused on it. Particularly the bond market's going to be watching this very closely. So the bond market will move and send the Fed and the White House very clear signals if they see that there's problems arising. And we saw this in April around Liberation Day, that the White House isn't unresponsive to those concerns that get expressed. They did pull back from the precipice, and I think they would again. So I don't know. It's clearly one to watch. David's absolutely right. This could be the big thing in markets next year.
It's probably worth clarifying just how the Fed operates. There's 12 people on the Monetary Policy Board that determines. It's called the Federal Open Market Committee. There's 12 people on it. 7 of them are called Fed governors, of one of which is the chairman, Jerome Powell. And there are 5 ex officio people on that committee that are governors or presidents of various state Federal Reserves, because each state has its own Federal Reserve Bank, as they're called, and there's a sort of a rotating panel of 5 of them who serve on this FOMC, and they have to be approved by the other governors, the 7 governors, and they're put up by the various states, and they actually rotate every 12 months. So it's quite a rapid rotation. And this is why the question of what happens to Lisa Cook is really significant, because Lisa Cook's one of the Fed governors, and Trump's been trying to get her removed. It's before the Supreme Court. If the Supreme Court lets Trump remove Lisa Cook for a trumped-up charge, it is, about that she's supposed to have lied on a mortgage years and years ago. If that happens, then Trump could get a majority, 4 of the 7 governors, including the chairman, in which case they could then keep blocking state Fed appointees to the FOMC until they got the ones they wanted. And so it could result, this is the proposition anyway, that it could over time, maybe in a couple of years' time, result in a majority, Trump getting a majority of the FOMC. It's a bit of a stretch, but he's clearly trying to do it. But it's certainly true that just appointing the chairman, Kevin Hassett or whoever it is, to replace Jerome Powell won't be enough, because that's only 1 vote.
Yeah, it's definitely one to watch. But I actually, to get back to the premise of the question, I don't think it's a black swan, because we can see this one coming. Black swans tend to be events where you're totally sideswiped by something that seems completely unthinkable.
That's right. They're the unknown unknowns.
John says, if we're in a housing crisis, why doesn't our immigration system bring in the people who can actually fix it? The cost of basic trades work in Australia is so high that something like fixing a toilet can chew up months of savings. Feels like our policy settings are completely out of line with the problem, if not contributing to it directly. I think this is a really good point.
It's a very interesting question, this, because most of the immigration at the moment comes from Asian countries, India, China, and also Latin America. And Australia's Trades Recognition Council, which is a government body that recognises trade qualifications, does not recognise the trade qualifications of those countries.
Yeah.
So they can't, the people coming in can't work as tradespeople because their qualifications are not recognised. They have to start again. They have to go and do an apprenticeship or go to TAFE and learn it again.
There has been some small-scale programs around this. I know in Western Australia they've brought in a lot of Filipino tradespeople who've helped exacerbate some skills shortages over there. But, I mean, Andrew Irvine, the CEO of NAB, he's been talking about this too. Like, it's pretty obvious. Like, get the matching of skills to what we need right. Find a way to bust through those trade recognition issues. Like, none of these issues are surmountable, are they?
I don't think they're that simple, really. I mean, I think it's, some of these, I keep reading stories about buildings in some countries falling over.
Sure.
So I don't know. I mean, I think it's
It might not be simple, but it's not insurmountable.
You wouldn't think so.
You would have thought we've had, 10 years of this being a problem to work on it?
I mean, it's certainly true that, when I was growing up in the 50s and 60s, most of the immigration, or most of the immigrants that came in then were concreters and brickies, and they were all tradespeople.
Yeah. I mean, can you have if you have to retrain, do you have accelerated training processes for these immigrants? Like, there's got to be, let's think a bit laterally here.
Yes. Avery says, one thing that needs more attention is the rapid offshoring of white-collar jobs. Right now, it's bigger force than AI in Australia. Companies can now send non-client work in areas like accounting, finance and engineering to places like the Philippines. This has been going on for quite a while. That's nothing new, is it?
I think Avery is right. I think there is a sense that it might be reaccelerating, particularly inside some of the big banks. A lot of their sort of more process-driven work, their tech work, is being offshored again. It does come in waves, Avery, but I think Avery's got a point in that there might be a little wave at the moment because the benefits from AI aren't coming through as quickly as anticipated, and there is a bit of a push on this. So I think there might be a little wave at the moment.
Yeah, right. Oh, well, it'll soon switch to AI, I would have thought.
Yeah.
Your turn, isn't it?
Paul says, hi all, had dinner with friends of friends, and conversation turned to renting, living and cooking. This couple, who were double income, no kids, late 20s, early 30s, rent an expensive home, eat out, Uber Eats, don't cook, holiday a lot, and they don't have kids. I wonder if this group and this lifestyle cohort is growing, and if there's a chance that in 30 years at retirement we see a cohort with little savings and no home but champagne tastes. The only thing saving them maybe is Keating's super. Is this previously non-government dependent group going to cause an issue?
It's interesting, isn't it? I mean, I think possibly this comes down to the question of, do you need to own a house when you retire in order to have a decent retirement? And I think you may, but certainly at the moment, given the amount of super that's around, I think you do need to own a house probably. And if you rented all your life and you haven't got much super, you're in trouble.
Yeah.
Well, you're on the pension anyway. I mean, look, I don't know. Maybe for people who are starting their super journey now, and they actually save on super for 40 years, or even more. Yeah, you'll be right. That's okay.
And perhaps to flip the question on its head, is that the issue here? If you are one of these people, you're sort of locked out of the housing market. The government's forcing you to save 12% of your wage so you can spend it, in 40, 50 years' time. Does that lead you to say, well, I'm going to enjoy my life now? I know the future's going to be okay because the government's forcing me to whack all this money away. I can't use it. Maybe that's why you see people approaching their lifestyles in a different way. I don't know.
Yeah, no, that's fair enough. And I think a lot of people are sort of deciding not to have kids.
Yeah.
Given the way childcare is so expensive, you get free education after the age of 5, but you've got to pay for it up to 5, and then you start paying again after 18. Yeah.
Maybe David's question's a good one to finish on, Alan.
Righto. David says, I've been listening intently to the productivity debate and how our economy is hitting a labour ceiling at modest growth levels, which then runs the risk of pushing inflation outside the RBA bounds. My observation is that the policy response to COVID artificially reallocated labour to less productive areas. For example, labour was incentivised to work in industries that were not subject to shutdowns, whilst there was an incentive for labour to move out of the private sector to the public sector where jobs were safer and insulated from COVID policy. It feels like labour unwinding and reallocation needs to take place to get the labour in the areas of the economy that need it, construction and health, etc., and out of the areas that are less productive, like the public service. Yes, well, look, that's already kind of happening, David. I mean, it's true that the what they call the non-market economy versus the market economy. The non-market economy has been growing, and that's led to a decline in productivity because the non-market economy is inherently less productive than the market economy, and also the shift of labour from goods to services, since services are also less inherently productive. So that's led to a decline in productivity growth, but that does seem to be reversing, at least at the moment, with more labour going into the market economy as the private sector recovers. So I don't know how far that'll go.
I mean, I guess the signals that you want to see are price, really. I mean, and the cost of constructing, the cost of building anything has risen, which should be sending a signal to the labour market that this is where you want to allocate resources, but doesn't seem to be at the moment. I guess I would just query on health. We have got a lot of labour shift into health. Maybe not enough, but there has been a lot of labour shift into health. If you think of the NDIS, aged care, healthcare in the last 5 years or so, a lot of it is employed by the public sector, though. So yeah, it's that probably goes to the complexity of this equation, though. It's not easy one to solve, is it?
Yeah, and I keep thinking about the absolute headlong rush that the world's going into humanoid robots. It's unbelievable, the amount. There's, particularly in China, there's so much going on. I mean, there's so many companies now building humanoid robots, expecting these things to make them money and sell. So I don't know. Maybe we're going to end up having healthcare and everything provided by humanoid robots.
Yeah. They'll never take this podcast, though, Alan.
Yeah, I like your confidence there, James.
Yeah.
Well, anyway, thanks. That's it for today. Thanks, everyone, for listening to Money Café this week. We're back next week, all three of us.
Oh,
James, Stephen, and myself will be live in the cafe, and we'll be at my other brother cafe in Camberwell at 8 a.m. It's at 586 Burke Road in Camberwell. It's actually on the car park in Camberwell, facing the car park. So if you'd like to come, you happen to be in Camberwell or somewhere nearby, drop in and we'd love to see you. And you could watch us live do the Money Café at my other brother.
Be there a bit early. I reckon we'll be kicking off at 8 a.m. sharp. It's going to be good fun. I'm really looking forward to seeing you all.
Yeah, and it's next Wednesday, so that'll be great. In the meantime, if you've got a question, send it to the Money Café at Eureka Report. That'll be our final one for the year. Then we're going to have a break. So until then, I'm Alan Kohler, founder of Eureka Report and the person on the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review. See you next week.